Here's what we're going to do. We're going to start to take the elements that are on the chart, or what I have to call, just for argument's sake, my system, and break it down, and then we'll rebuild the chart by placing the things back on as we go through them. So we're going to do some boring stuff. We're going to look at moving averages. We're going to look at the boxes, the shadows. We're going to look at all the individual components that are on the chart. And in essence, what we're doing is stripping everything away and then showing you how to use these old-fashioned, outdated technicals for our purposes to help us understand how to identify the market maker pattern and behavior. Why do we use these? Well, here's the deal. The dealers fake to these areas, moving average crossovers and things, because that's where the retail traders and the books teach people to take trades, breakouts, price crosses over the 20 EMA, that kind of stuff. So since we know that retail traders still follow this stuff, it makes sense that the dealers would do certain erratic behaviors, fake past the mayonnaise and come back, fake by the blueberry. It makes sense that they would do these behaviors. They would present an M or W formation just past the blueberry because they're inducing traders to take the crossover. Okay? So that's why we're going to break it down, and then we're going to put it back on the chart one piece at a time. So we have a trading system per se, which is essentially your reason for entering the market. It's called your setup. Okay? So whatever that is, you got an M formation on a pivot level. USD-CHF is past the blueberry. That's your reason. Your level count, you have to be cognizant of where you are in the big picture. Now, I don't mean necessarily intraday. And a lot of people, Kim K and Dick, will tell me that they don't use levels and look at them, and that's okay. They use the pattern. But you have to understand that you need to know where the big or dominant trap move was placed. So if dealer made a trap low on Monday, and you're coming into level 1 consolidation, if he fakes an M to the upside, you don't want to take that because that is a sucker's trade. That's for the breakout guys. Here's what I mean. If the dealer anchors in here and comes out and does this, and then the next night he does this, or at the open he does that, this is a no trade. That's a DNC. It's not the no-fly zone, it's the do-not-counter zone. All right? You do not trade back towards the peak coming out of level 1 consolidation. I think somebody said that once. So being cognizant of where you are in the levels, the trend in its direction, and I'm not talking about the retail sucker trend, I'm talking about the dealer trend, which we'll cover the anchor points and how the dealer presents. You simply need your reason to buy or sell or stand aside. Whatever those reasons are for you, you need to develop that over the next few days. Steve, I'm only going to take W formations on the mayonnaise between 1 and 4 a.m. or between 8 and 10 a.m. That's a reasonable trade plan. Okay, you got to have a signal. An M is not a signal. A W is not a signal. Okay, maybe the signal is the high is formed on the vectors. Vector to the outside, the dealer makes the second pass. A hammer is issued after he extends the high or low one more time. It's a confluence of triggers, a confluence of events. It's shark fin high, blood in the water at 3:45 in the morning, a hammer after the dealer's already established the high and held the level for 1 hour. It's a confluence of things coming together. So you would say, Steve, what's the ideal trade? The ideal trade would be you walk up to the screen, you've identified the peak formation, you know where you are in the cycle. You analyze the chart in seconds by doing this. Asian range, less than 50 pips. The dealer is in a tight consolidation. He has happened to shift the Asian range to the downside. He is now consolidating by the bottom of the initial low of the day. The dealer makes 3 vector candles and extends the low quickly and lands the first vector leg right past the mayonnaise. He pulls that back 25 pips to hit the stops of anybody that went short and to induce them to go long. He pulls back again and makes a second leg slightly higher than the first and right on top of the mayonnaise, but he opens the spread and grabs any money that's laying there. He closes on a hammer and gives a small crossover candle and confirms by closing above the ketchup. I happen to look at TDI. It's overextended at the bottom, below the two support lines. And there happens to be a shark fin crossed back over with blood in the water going back underneath the ocean. That's a trade. That's a confluence of triggers that you happen to notice. All those things coming together. That, my friends, is an ideal setup. And that is what I mean by a confluence of things. There was 4, 5, 6 things going on, including the timing element, the time of day, that are our triggers for us to take a trade. Because when you stop and think, the dealer faked past the 200 EMA, mayonnaise. TDI picked up by shark finning. Perhaps there's divergence. Maybe it made its first pass inside the band, the second one outside the band. Stuff I'll talk about. Okay? Very important. You've got to have a fixed stop loss. I talked to you earlier a little bit about stops, but you got to have some way to protect your equity if you're wrong, and you got to have some way to protect your profit if you're right. You can't just put trades on, put a stop, put a limit, and walk away. And that's in textbooks. I've read it. It says, let the market prove you wrong. And that is one of, along with risk appetite, that's probably my second, I don't know, it gets under my skin, pisses me off. Because if you let the market prove you wrong, it'll prove you wrong every single time. The market swings. It's what they do. It's by design. So they'll swing you out of a profitable trade in a matter of seconds or the blink of an eye. After you've had 4, 5, 6 hours of profit, they'll take it right back and end the day near your entry. So what you need to do is trail the stop, jump the stop, have a strategy to exit if you're wrong. Preserve your capital. Hang on to your money. These are the things that separate the men from the boys, or the girls from the women. I had to say that. Puts hair on your chest when you get it right. Here's what I mean. You get in, you find a perfect M formation, you put a stop, you put a target, you don't walk away. You at least, at a minimum, trail by 32 pips. At a minimum. Now I'll talk about the stop loss and its placement and the distances in a little bit. Jumping stop is simply where you cancel and jump the stop up behind the next consolidation zone if you become a swing trader going for the full run for the day. Remember in the areas where I told you the dealer hits the stops, and moves? I said drop. He goes like this. In here. Okay, well, you have to account for these, and you have to move the stop in behind this after it commences. We'll talk about that. Understand, like the lecture I just gave you about the shoe store, you have to preserve your equity, preserve your capital, because that's your inventory. That's all you have to work with. You got to have some type of profit target. Just because Izzy took a euro trade doesn't mean it's going to go forever. Remember I told you that dealers are confined in the amount that they can use in a day. 200 pips on average. Some days bigger, some days smaller. But just because you caught a trade today doesn't mean it's going to go 627 pips. It's going to go what it's going to go on an average daily move. So you have to either have a place to take during the day or convert a spot to a swing trade. Or, like I mentioned, a fixed 50 pips would be great. A fixed 35 or 40 pips, whatever you're comfortable with, that's a reasonable amount of money for you to achieve. Projected. The projection might be you're a swing trader. You know that the market maker cycle is a 3-day cycle, right? So you take ADR times 3. Okay, let's say ADR is 100 pips, and I can't add fast in front of everybody or subtract, so let's say ADR is 100 pips. ADR times 3, which is a 3-day cycle, would give you 300 pips, right? So you take a projected level by simply taking the peak formation low at this number here and adding 300 points to it or 300 pips to it, and that will give you your projected high. Right? Because you would have 1 day, 2 day, 3 days before the reversal. So you have 100, 100, I left the 0 off, and 100. So that's what I mean by a projected target. If we know the dealer cycle is 3 levels of rise over 3 days, then the projected target or upside target or downside target is simply ADR times 3. If the ADRs are a little less right now, then if they're for some reason running at 88, then it's 88 times 3 for the top side target. They're not going to give you, because you took it, more pips. They're going to give you what's available to you, and you have to realize this and be objective. Okay, Steve, the ADR has been a little tighter. Australians run at 92.375. Then the answer is 92.375 times a 3-day cycle. After the anchor point, the high of the week or low of the week is established, and I want to convert my spot to a swing, I can expect 97.3 times 3. And I start looking for the door or the reversal pattern on the intraday cycle. So if I took peak formation low and I nailed it and I'm in here and price rises away from that area nicely and I decide this is a pretty good trade, I feel like I got the LOW, the low of the week, I'd like to convert that to a swing trade and try to hold on. I've always wanted to expand my take and try learning how to take more money off the table. Then what do? You look over here in the corner on the indicator, and you take the ADR marker that's on there, and you look at what it's telling you, and you multiply that times 3, and you add that number to the peak, and if it's an M, you subtract that number from the peak number. You take the high of the day or the low of the day at the time the anchor is formed, and you add 3 times ADR, or you subtract 3 times ADR from the high or low of the day when those are established. And that is your 3-day cycle upside target, downside target. That is a projected, a true projection of where the swing trade will terminate, or where you should terminate the swing trade. Okay? And obviously, if non-farm's coming out, if other things are on the table, then you need to take on Thursday before those things produce. Somebody sent me an email and it broke my heart. A new student, and they told me they had an EA on their account and it was doing pretty good and they were happy, and they left it through non-farm, and in the blink of an eye it halved their account. That's why those things don't work, because they get you excited and jacked up, and she invited her friends and family in, and they all got halved. Any profit she made plus her own equity, gone. Okay? James, I don't understand the question, the 3-day start. The 3-day start comes on the high or low of the week when it's established. So if the anchor point is made, let's say the low of the week is made on Wednesday, then you got Wednesday, Thursday, Friday, and you're looking for the door. Yeah, and don't drag any trades through the weekend, man. Don't drag any trades through the weekend. The world is too volatile right now, I guess. There's too much risk appetite in the world. There's too much momentum. I'm kidding, man. But seriously, don't carry trades through the weekend. Very important point. Because seriously, something can happen in Greece, something can happen in Europe, something can happen in the States, and then they're going to gap you with a monster gap. And if you know anything about page 237 that's built in the back of your trading manual that you signed up for on your dealer, it says they can fill you at the first available price at the open. And you have to take it, like it or not. And that means that they burn through your stops. If your stop is at 29.07 and the first price is at 26.02, you're getting filled at 26.02, my friends. They could care less. Sorry about your luck. Don't drag trades through the weekend right now. The world is too unrestful, or whatever the right word is. Too much garbage going on in the world. Okay? All right, so very importantly, you've got to have a money management plan. You've got to know what your lot size is going in, what your risk is, contract size, scale-ins. Jim is going to discuss money management tomorrow and his take on it and what he does. So I'm not going to spend a lot of time on that. But there is an algorithm for you to ramp up your lot size to achieve a seven-figure payday. It's in there. If it's not, I'll post it in the forum, but I'm 99% sure it's in there. But my programmers, Joe and Ray, have been working on the folder, so I don't know if that fell by the wayside. Pretty sure it's in there. Okay, so system components. Understand that the market maker pattern outweighs all 100-year-old man-made indicators. In order for us to understand how to read charts and identify the market maker's true intentions, I took some widely used indicators and applied them to a chart to help us understand timings, the entries, and the exit. That's all. Since most of us have fallen victim to these popular technicals, rainbow stochastics, MACD diamonds, RSI crossover, CCI rejections, using them allows you to make the transition faster because most of you know how to use this stuff already. So since you already know how to use it, I don't have to teach you how to use an indicator and then identify the behavior. You already know how to use most of these things, put them on your chart, so that allows you to transition much faster and hopefully shorten your learning curve. Okay? So some of the components that we use, or the components that we use, are the 513, the 50, 200, and 800. These are exponential moving averages. Why EMAs? Well, simply because they place more weight on current price action. And I told you that looking at past technicals is no guarantee of what price action will do today or tomorrow. So that's why I like to place more emphasis on the last 3 to 5 days of data, the last 2 weeks of data, what's going on, what the dealer's showing. Because I just showed you where Australian was in an uptrend for the last 6 months, and then in 1 month the dealer takes it all back. What do you call that on the technicals? I don't know what those guys call it, because if they were following the trend, they got crushed. But I can tell you, when we mark that chart and everything that I've ever drawn for you is in there, that to me is nothing more than a market maker pattern. So drawing support and resistance and lines and trend lines and things that the regular people follow, you would have gotten crushed. Okay, basic candlestick patterns. I think someone asked me about the outside structure. This is where this will be covered. We'll look at the basic things that the dealers do with the candlesticks. Color-coded sessions, those are simply the boxes, the shadow boxes. I'll break those down into detail and explain. Crossover arrows with alerts. The little arrow that pops up, that box, some of you hate it, some of you love it. You could disable it, no worries. Is when the 513 crosses over, you get an arrow that fires. And that will help you determine if that is a confirmed entry. We'll talk about that stuff. We'll look at some pivot points. The projections on where the high and low may form. TDI. We'll take Dean Malone's TDI and break it down for our purposes. And we'll apply it to our entries and our exits. Market maker level counts. We'll try to identify where we are in the cycle. I'll show you the dealer trend and how it sets up. We'll talk about ADR, average daily range. We study average daily range because that is where the dealers have to stay within their confines, so we can expect them to return back into the range and end in accumulation or consolidation. Okay? So let's look at trend evaluation and count, how to check down what to trade, best time to enter the trade, and how to manage it while it's on. First thing, when you walk up to your chart, you want to identify if you can see where you are in the dealer trend. What's the dealer cycle? Where are we in the count? And the way to do that is to understand it and be able to identify it. There are two types of trends. There's the market maker trend, which is the real, genuine trend. The technical trend is what the dealer shows the rest of the world. That is the sucker's trend. And that's not my terminology, man. That's what I was taught. It's a patsy's trend. Because what's happening during the patsy trend is the dealer is pawning off his contracts that he doesn't really want. Think about this for a minute. If I know I'm going to correct the market, right? If I know that this is coming, if I know I'm going to do this, how do I make patsies out of everybody? By making them buy. So that's the difference between the patsy trend or the sucker's trend versus the real trend with what I know I'm going to do. I show everybody that Australians gaining strength for months and months and months, and I pile on the last batch of suckers heavy because, my goodness, can Australian keep going up? I just can't believe it. Can it keep going up? I think I'm going to put my $10 million stake in there. I think I'm going to put my entire hedge fund in long Australian. What happens? The dealer goes, all right, we got a really nice take. We got a lot of long holders. Time to drop the bottom out on these guys and get all of our money back. And if you look at that chart, the dealer ended where the whole thing started last May or last October, wherever it was. So that's what you have to understand. What the technical world sees is the patsy or sucker trend to them. From their eyes, it's a sucker's trend. I proved to you that the levels are visible on all time compressions with that little test we took this morning. Okay? You looked at a weekly chart, and it was no different than the 15-minute chart. The levels are, in my opinion, every time I say this, I get people argue with me. They're highly visible on the 1 hour chart. I could see them on the 15 and the 1 hour. If you can't, if you could see them on the 4 hour, then knock yourself out. Whatever it takes for you to see clearly is what I'm concerned about. But I would like to collectively as a group work off of the 15-minute and the 1 hour for intraday purposes. And if you're going to swing trade, let's work the 1 hour or the 4 hour. Okay? So, to further the point on the trend is set by the market maker. It can be reversed at any time. Understanding this gives you, in essence, an edge and allows you to trade both ways without fear by understanding there's only one part of the cycle that you cannot trade against the dealer. And that's where, coming out of level 1 consolidation. So don't become so biased that you miss the setups. Don't be like, oh, it's going up, it's going up, it's going up. I'm looking for a W. And then the dealer throws an M right in your face. Then you go, nope, it's going up. Understand that the dealers trade both ways. The dealer makes a high for the day, trades off of that high, comes back into the range. He'll make a low, comes off of that number, extends the high, ends the day in the range. Why are you, because the textbook's so bent on, oh, the trend is my friend, I buy pullbacks in an uptrend. I sell rallies in a downtrend. That's textbook bullshit. Your job is to identify where the dealer's at in the cycle, and you take a short position near the high of the day, and you take a long position near the low of the day, and the only time you don't do that is counter to the peak formation coming out of level 1. All other times, it's open game, baby. Trade both ways. Understand? Don't get so caught up in a directional bias or get yourself locked into a move and then you drive yourself crazy when it doesn't perform the way you thought it was supposed to perform. You've got to be fluid. Okay? I'll play that song for you before the end of tonight. The dealer song. The trend is generally, okay, as soon as I say this, you're going to go, but Steve, Euro fell 5 days. It's set up as a 3-day cycle. With day 1 being reversal day or peak formation high or low day. What happens is it comes as a market surprise. So what happens is the dealer has been dropping for a couple of days and he lands and hits a number. And that number is the number that he was ordered, told, or there happens to be a certain dollar volume below that, above it, whatever, where no mas. He's not moving, no more. That's it. That's the number. So what happens? The dealer goes into accumulation to further catch traders short, makes the second leg, and this becomes the peak formation stop hunt, this area, this behavior in here. This is day 1 as the reversal. It comes as a surprise and catches everybody off guard except us. Why? Because the trend is down. People are selling into open moving averages, 50 crossing the 200, things that show down. People are selling into that. So when he puts the brakes on and doesn't hit another pip below and holds this level, that's a pretty good sign that you are in day 1 reversal. The dealer has applied the brakes and has caught everyone following traditional indicators off guard. The news, non-farm, Geithner, whatever, FOMC, the traditional things that come out are used to perpetuate the false trend. Before they hit the reversal, there might be a big news release here that spikes further down and shows, oh my God, the trend is down. Everyone has to sell. Okay? The dealer applies the brakes and pulls and holds at that number. Day 2. The moving averages on the higher time frames will signal. Perhaps you're going to get a 50 crossing the 200. If the move was aggressive enough coming out of level 1 rise, then what would happen is you would get the move maybe late in the day on day 1. But crossing of the 50 and the 200, since a lot of indicators, MACD, are based on averages and price, that move will force traditional indicators to offer up a signal. You might get a zero line on the MACD crossover, RSI across its baseline. Because price is rising as a market surprise, now what happens is, on day 2, retail traders are going, I guess the trend is, reversal is on, and there's the signals. A lot of traders that trade these traditional indicators will use a validation method or a breakout method to validate the signal. What I mean by that is the reversal would come on, price would go up, make a pullback, and then they would take validation above, a break above this area to be validation. Well, they're late to the party, my friends. When retail traders are waiting for their confirmations, the dealer most of the time has already established level 3. So, understanding that, what market makers are doing is forcing them or forcing their hand to get traders to commit the funds. Remember I told you that if they didn't allow you to be right once in a while, it would be game over. If you opened up an account, threw 10 grand in there out of your savings, you went to work and in 4 days they wiped you out, would you say, honey, I almost got it, give me 10 grand more? You'd be like, psh, that was the fastest I ever threw 10 grand away in my life, I'm done. But because they allow you to get it right, It keeps a lot of you holding on 3 years, 2 years, 4 years, 5 years. Because within that construct, you've had moments of brilliance where you made $5,000 or $3,000 in a matter of a few hours or a matter of picking a great trade. And that has made you understand that if you can make money that easily and you can lose money that easily, that if you just learn to make it all the time, it'd be a lot better. So what happens is the dealers allow you to win by validating or confirming what the retail traders see as part of their cycle. You understand? So when they make the market surprise, they caught everybody holding shorts, they shift away. Retail traders wait for some form of validation that the trend is now changed, and then they pile on. All the while, the dealers secretly know what's going to happen. They know that, we're going to rise it up, take back our money, analyze our book, and then continue or reverse again. They have to do this in order to keep people replenishing their accounts and joining into the trading industry. They have to show or let you have your moment in the spotlight, your moments of brilliance, where you can take your account and double it. This is what keeps traders coming back and replenishing. It's an important part of the cycle. Day 3. Traders are convinced that this is the real move now. Market makers show trend acceleration. How do they do that? By separating, what I talked about, they separate the moving averages. Right? The averages are fanned out, prices dancing on the top side of the averages. It looks like it's going straight to the moon. This is called trend acceleration. Again, the news is used. There might be another announcement this week that creates it to spike higher. And then what do? They apply the brakes and trap everyone except us going the wrong way again. And they might do that with an aggressive outside structure. They'll hit it high, pull back, and then hold off the level. And everybody validates that in their mind as this, that it's going higher. Okay? The reversal by the market maker is used for him to book a profit and nothing else. Think for a second. Do you really think that the broker's matching you up with some dude in China or somebody in Omaha? The dealer has to book a profit. So he does that by taking the other side of your trade, piling on enough contracts, and when the contracts are straddled in such a way that it's in his benefit, net longs versus net shorts, he corrects the market against those traders, or he rises the market against those shorting. Think, you know the dealer takes the other side of your trade and he hopes to God you haven't had my class. The reset. Okay, trend reset's a little confusing for some. It's okay. It's a way for the dealer to correct quickly against the trend, book a profit, but continue or not reverse direction. A trend reset will be used for market makers to book a profit and continue on with the larger target, the seasonal target, or whatever they're told that they need to do. The reset will represent a new peak formation. When a new peak formation forms, 2.5 to 3 more days, 4 days can be expected. If no one falls for it, he may reverse after only one more level of rise or fall. So here's what I'm talking about. Okay? The dealer hits 3 levels. He pulls back. He throws a reset in here. He comes back and rises one more level. People have not let go of their short positions. So instead of, or they're not going to let go of their long positions, so he'll say, all right, you don't believe me? I'll extend higher, or I'll come back and extend lower. It depends on his book. Understand that if no one falls for the extension or the bite, He'll reverse the direction after only one more level, possibly. Okay? And the explanation or the answer is, Steve, how do you handle that? You use a stop loss. That's how you handle it. Remember Dick, 3 out of 4 losers turn to profit. Why? A hard fixed stop and a mental stop. The difference between an amateur and a professional. Your bias or your analysis of the market is only a prediction of what you think will occur. The dealer doesn't give a shit what James Nunn is thinking the direction of the market's going to be today. The dealer cares about the amount of open positions in his book that he has to cover by either rising price or lowering price. He has to protect his equity, his risk profile, his appetite. I'm kidding. Hate that word. He has to understand what his firm has in net longs versus net shorts and what his targets are based on those numbers to keep his firm in business and keep them profitable. That's it. So he doesn't care that you projected, peak formation reversal, and then he comes back and his book says he's got to go higher. Okay? Once the peak is identified, the trend bias will be in line with the peak formation for 3 days. Day 1, level 1. Day 2, level 2. Day 3, level 3. Is it safe to trade V bottoms and V tops if you have clearly identified the cycle, direction, and trap move? Absolutely. It is safe. Okay? Here is a typical dealer cycle. You have consolidation, the dealer, vectors, right? We expect vector candles to the low. He forms that low. This could also be false move week beginning. First part of the week, let's say it's Sunday, Monday. The dealer has exploited the psychological support and resistance barrier. The first 8 hours of the session, he's established the Asian range of the week. He vectors to the low, false move week beginning, induces traders to go short. He makes the aggressive pullback on Tuesday. We expect to see a rise Wednesday, Thursday, Friday, and then end the week back in consolidation off of the number. So along the way, what do I expect? Once the anchor is established, I'd like to see a safety trade or a straight rise out of here. I was expecting this. I was hoping he would give me a nice formation as a safety trade. If he doesn't, no worries. The next day, I expect, again, stop hunt low rise. Going into Friday, since I know it's the end of the week, the cycle may be cut off based on that, where he'll pull back and trap to end the week. Remember, false move week beginning, false move week ending, trap move, the end of the week, the end of the session, to jam the traders into Sunday, Monday, force them to pay swap, and hit them with a fat gap on the open. Okay? Typical trend setup. Here you go. False move week beginning. The dealer has faked past the 200 on Monday. He has ended the day in consolidation. He gives me a beautiful stop hunt. Look at the 3 vector candles. He vectors right past the mayonnaise, hits a star formation, and comes back above the mayonnaise closes right on it, and then breaks it on the next move. Stop, hunt low. Day 2 is expecting this. He only had 2 moves out of here, straight rise or safety trade, stop, hunt, low, rise. And I think Jim measured this for me, and this was the 618 retracement of the previous move down, something like that. Anyway, he knows I love him, busting his chops, man. All right. Again, the dealer has given you the straightaway trade on the last day of the move, but you can still see the pattern in here. Why don't you trade this, Steve? Because I'm expecting this in line, and I'm looking for a 33 trade. Three bursts towards the high. The dealer ends on hammers, hits the stops, rolls it over. Okay, let me erase that so you can see it better. Look at all the pins to the top side. See them? Look behind the moving average. See the M in the moving average right there? Stop looking at the candles, look at the yellow line. There's an M formation. The dealer has to reverse to take some money back. Projection is water and then mayonnaise. Okay? This is a typical dealer cycle, typical dealer trend. What happens is when everybody sees the trend, they buy the pullbacks in an uptrend, right? Well, when you buy here and expect this, the dealer does this. And he says, I'm sorry about your day, buddy. Identifying where you are in the count will help you project what the dealer's next move is going to be. The peak formations must always be identified. Look at the 4-hour chart. Bracket off the first 8 hours. Look for the dealer to exploit the level and form the HOW, the high of the week, or the LOW, low of the week. We're going to look at that in here, don't worry. If a double peak formation appears on a higher time frame, lights out. You got them. What do I mean? If you have the peak formations on daily, 4-hour, 1-hour, all coming together at the same time, you own them. You got it. Okay? Here's an example of that. This was, looking at the pound daily, this was, I can't remember, last holiday, October, November, when pound was rising. Look what it did. Okay? 3 months. 3 levels of drop, 3 levels of rise. It made the outside structure high or railroad tracks to the high, pulled back, trapped traders, and dragged them down for 3 months. It got all the people long that thought they were going to have a nice Christmas, and they corrected against them, and by Christmas time they were broke. Couldn't buy G.I. Joe with the Kung Fu grip. Some of you know what I'm talking about if you saw Trading Places. Okay, so they went and rose back in 3 levels. They hit that number again and issued a pin and pulled away. They went near that number again. That is where we realized the joke is don't ever hit the high or low 3 times in front of me. All right, here's what we saw on the 1-hour, the M forming. Okay, the 4-hour, same thing, November, February. The high was holding. You simply had to draw a line across here. Realize that the dealer wasn't going to break above. This pin picked up all the breakout traders. This is an outside structure to the high. The dealer picked up the breakout orders, pulled them in, induced, and then in the session said, sorry about your luck, and dropped the bottom out. This is what I talk about when you look at the bigger time frame. I want you to learn to become proficient in the 15-minute and 1 hour. But looking for the psychological support and resistance zones, the high of the week and the low of the week, within the confines of the 4-hour or the bigger picture, understanding that if the dealer's near an all-time high and all-time low or yearly high, yearly low, those are sucker plays. and he's going to probably spike above and pull back. And handling that high or low is no different than any other high or low. You handle that high or low by if the dealer hits it and closes below, it's a correction. If the dealer hits it and stays above, it's a continuation. That's how you handle it. Okay? Totally different story if this pin right here stayed green and the dealer stayed above. If the dealer in this area stayed above this area, then you got a continuation as expected. Okay? Okay. Intraday trend, no different than the peak formations for the cycle, the week. It's when the anticipated directional move lines up with the peaks. Begins after the stop hunt. So what do I mean? The segment of the market, okay? The peaks are the anchor. You have a stop hunt, and then this is the segment of the market. This trend right here is the anticipated move. Okay? Correction, which is a stop hunt, and then back in line with the trend. Okay? Intraday, you might have 3 levels of rise. You might have Asia, London, and then US will be a slight rise and a correction. Remember, the third session will be corrective in nature. And if the third session closes high or closes low, then the correction will come early Asia or London in the form of a stop hunt, which would be this segment of the chart right here. Understand? Those are for the people that trade 5-minute, 1-minute garbage charts to get them going the wrong way. Because on the correction, the corrective leg of the chart, the stop hunt leg, the dealer is showing a down move. But if you don't understand, if you don't look at the big picture and don't realize that's a stop hunt, first leg, vector leg of the stop hunt, you take that garbage short on a 1 or 5-minute chart, and if you don't get out with your plus 3 pips, you're going to be stuck when he reverses on you. Another reason why those charts don't work. Okay? So, the anticipated directional move, man, that's messy. The anticipated directional move comes in line with the peak formations. And it comes after the stop hunt. After the stop hunt. This move, the continue of the trend or continuation of the trend or direction for dealer direction for the day, is 6 to 8 hours. When level 1 is identified, these trades offer more pips. You usually get, where are the aggressive move scenes? Where is risk appetite into the market? Level 1 and level 3. Because the dealer's got to get the hell out of there. And to get the hell out of there doesn't mean to chop around. To spike or shift the zone aggressively away from those traders holding those positions makes them lift their stop and do stupid things. So the aggressive big move is seen coming out of those levels because he wants to get the hell away from that price point, make you lift your stop, get you into margin trouble. So when they make the surprise market reversal, after they've locked in their book of what they need, they will get the hell out of there very aggressively, which in turn takes the retail traders to lift their stop, gets them into margin trouble, gets them into a panic, gets them averaging in the wrong way, and all kinds of other erratic behavior that lines the pockets of the dealer. Okay? Will all time frames always line up? Absolutely not. This is a retail trader's trap. Don't get caught by the market maker thinking the 1 hour, 4 hour daily is going to line up. Garbage. The pattern, the pattern, the pattern. And the new saying, be loyal to a pattern, not the pair. Be loyal to the pattern, not the pair. That's our new slogan for 2012.